Hi there, Serial Trader here. I'm going to take a look at the major US indices. And okay, getting back to SPX, since the last video, we've come down deeper than anticipated. And I think in the last video we were just still sitting around this 38.2% retracement from this initial move up that we had from the February 24th low. And now we've gone down and actually on an intraday basis stabbed below the 786 retracement. So quite deep. So I'll just remove these other retracement levels, leave the 786 in place since it's still currently in play. And okay, so the question is a bullish outcome still possible here despite this deeper than expected retracement? Well, it is, but it's looking less likely. So let me drag maybe this C wave over here and just bear with me, a little relabeling. And just for the sub-label of the C wave, you could certainly get a 1, 2, 3, 4 with an extended 5 for C, for either this larger 2 or B. Okay. So this is certainly a potential scenario as long as we hold these lows. And you can see this technically works as a little impulse wave down. Wave 3 is a little bit longer than wave 1. Wave 4 does not overlap with wave 1, and in this case wave 5 is the longest, but as long as wave 3 is not the shortest, which it isn't, that's acceptable. So a little extended fifth there. So this is possible, but this requires us to basically turn up almost immediately if we're going to be in this more immediately bullish scenario for 3 or C, right? And judging by price action off of this current low, and technically we still have made a higher low above the February 24th low for now. So you can say we're certainly torturing the lows, but have not actually broken them yet. So it's kind of a dangerous game guessing that you're going to break something before it actually breaks. Now, I admit, it does look like it's getting more likely to break, but what do we have off the low here that we did on the 8th of March? We got up, down, up. So maybe an ABC up, but what do we have down? ABC down. Okay, so far. Now this could be ABC up and we could have a 1, 2, and if we gap down Monday and start trending down, then maybe we got something more substantial to the downside, but that doesn't happen yet. So talking about that right now before it's happening is just more or less guesswork or theorizing. Okay, so what would this maybe look like if it was a the initial bullish development of this low should we hold? Well, we might be working maybe an ABC up for a 1, ABC down for a 2, a 3, 4, 5, maybe like a leading diagonal off the bottom there for wave 1 of 3. That's certainly possible, but not nearly enough pattern development to even be thinking about that yet. So for now, it's undecided whether this is actually going to come down and sweep the lows or not. But here is the bullish count to work with should it hold, and certainly to be added to later upon further price action. Now, let's look at a more bearish scenario, at least on a shorter term basis. And I don't know, 4 hour, maybe we'll look at the daily. And just let's clean up these labels for now. Okay, so what would we be working? I like to just do a fresh count now that it's been a while from our January 4th 2022 all-time high. So we got down, up, down. Some people think this looks like a 5-wave decline, this initial decline. I would argue, where's the wave 4 to match the wave 2? If anything, wave 4 should be more evident than wave 2, and it's not. It should be more time consuming than wave 2, especially since wave 2 was sharp. So to me, you just got a down, up, down. You got an ABC down, right? So A, B, C down. And maybe we'll drop this degree down here. And then when you have up, down, up. So A, B, C up. A, B, C up. Now, there's nuances as to how you'd want to count this on a short-term basis, but let's not be picky on this time frame. Up, down, up is what we're working with. Okay. And now what do we have? I mean, this doesn't look that convincing, but maybe I don't know, ABC, X, A, B, and now we're maybe working C down, possibly. So this is a little more ambiguous. These were fairly easy three-wave moves. This one, it's just choppier, more overlapping. But I think maybe we're working something like a triple zigzag. So we would have the initial wave ABC down for W, ABC up for X, and then we'd have a Y wave down perhaps, another X, and now maybe A, B, C for the Z wave, WXY, XZ, triple zigzag. And let me just drag us down here a bit. And that would mean that this wave 4 of the larger time frame isn't just quite done yet. Need to go a little lower. And okay, if this is the count that we're working with, and I mean, the subdivisions of this Y wave aren't the greatest, but it's definitely not a 5-wave move because you got the overlap here. So without going into too much detail, let's just call that the Y wave. This looks like an ABC up for X. You can make the case. Okay. Now, what are we looking at? So we got WXY, XZ. So we can look at some wave relationships as far as downside targets. So we'd have the length of W off of X. Equality would be 39.36 for the Z of 4. And what else would we be working with? We could do the reverse fib, the 1.32 and 2 of this X. And 1.32 gets us right around 4,000. 2 gets us to 38.12. Okay, so we're starting to get a little cluster here to the downside. And then I think if I go on the larger time frame here, so if we are still, and I think at this point we should still be considering this potential wave 4 for this wave 2. In fact, the only place where this is no longer considerable to be a wave 4 is if we overlap with wave 1, which is at this level on SPX at 35.88.11. So that's definitely a line where we can no longer consider this a 4th wave correction. We'd have to look at it as being something else. But until that happens, no need to go there. But what I was going to do is, okay, so if this is a retracement of this proposed wave 3, we'll put up the 38.2% and 50% retracements. So we've already gone past the 38.2%, so let's remove that. 50% retracement would get us to 4,026, okay? And then if this is maybe something else, if this is more of a retracement of this entire move off the March 2020 low, then what would we be looking at as at least an initial retracement level off of that? We'd be looking at the 38.2%. Let's leave that up there. And that would get us to 38.15.20, okay? So we're starting to get a zone of areas here, a zone of interest, let's say from 3,800 to around 4,000 or so. So if we do break these lows from the, if we do break these lows from the 24th of February, I think you could be looking to anywhere from 3,800 to 4,000 as a potential buying area or an area for the market to find some support. Now, what's always kind of dangerous about getting bearish during, now there's different types of corrections. There's really strong downtrending corrections, and then there's more of these meandering, choppy corrections. I think this is pretty obviously more of a meandering, choppy correction. I mean, for all the bearishness that's out there, all the bear talk, we're basically still sitting at levels that we were, at the end of January, and now we're well into March, okay? So despite all this supposed bearishness, we haven't really made much downward progress for quite a while here. Now, we certainly haven't made any upward progress either, granted, but if we were in a real strong downtrend, we wouldn't have to be debating all these intricacies of, corrective moves. We would just have strong lower lows and lower highs. It'd be punishing, and it would just be strongly trending down. I mean, an example of that, what would I point out recently that looks more like that? Netflix, for instance, the stock of Netflix. This is what a strong downtrend would look like, okay? Yeah, there's been some bounces, but you are getting killed here in Netflix. Not so much in the S&P 500. Very different look to it, right? This is a strong downtrend. This certainly looks more like a corrective downward trend, not a strong downtrend. So given the reason I'm saying that is given that notion, you could easily come down here, and let's say we do come down and we just touch, you know, maybe we're looking at the subdivisions of the Z wave here, right? Now, you might be expecting, and let's just also put up relationship of this AB for this C for the Z wave, and let's do equality for that as well. If it's just going to be a simple zigzag down, up, down move for Z. Now that would get us down to 4,040. So again, that 4,000 area, give or take, is coming into play. Now there's a possibility we come down here, is what I'm getting at, since we're not in a super strong, and since we're probably near the end, if we're not already done, if we're near the end of this downward correction, it could be weakening, right? So what I'm getting at is, what if we just take out the the February 24th low at 41.14? What if we just barely take it out? What if we just touch it by a few points below it, right? Like a real weak test of that low, slightly break it, and then reverse up strongly. And you're getting all bearish, you know, thinking you're going to sell short and cover at 4,000 or 3,900 or 3,800. What if that happens? It could easily happen, right? These last two times, so on the January 24th kind of stab down we had there, quickly rejected and had an upward move. On this February 24th low, where we just on an intraday basis sweep the January 24th low, and that very same day closed significantly higher and closed up for the day, no less, and had some upward recovery before we turned down again. There just wasn't much juice to squeeze out to the downside, even though it was, you know, quote unquote, a bearish move. So we could easily be looking at the same kind of thing here, even if we do take out these lows, which isn't a guarantee. Like I said, in that prior scenario where the low was already in, and, you know, if we turn up basically immediately, that could happen too. So my idea is, don't be getting too bearish here near the end, or maybe even the end is already in place of this corrective move. And don't be too confident that we're going down to 3,800 or even 4,000. It certainly could happen. It would certainly look pretty on the chart and meet some nice, you know, targets and relationships. But again, that'd be an area to me to be getting more bullish, to be putting on more long positions, not selling short. Or if you were already short, that would certainly be an area to start closing those positions, in my opinion. So just some food for thought there. But yeah, we could, bottom line, if the low is taken out, then I think triple zigzag would be my best stab at a count off the all-time highs there. Anyway, we'll probably move on from that. So if we go over to Thinkorswim, so daily candlestick on Friday, we did have a bearish engulfing candle. So that is suggestive of lower prices, just on that alone. And on the weekly, anything to point out here in weekly SPX? Not particularly, although we obviously in a weekly downtrend here had a fairly large candle to the downside. What else? We head over to Dow Jones Industrial Average. Same thing, daily bearish engulfing, suggesting lower prices. Weekly, same look as the S&P essentially. And what else? NASDAQ Composite. Yeah, daily bearish engulfing candlestick, suggestive of lower prices. And another thing to point out before I go to the weekly here on the NASDAQ. So on that January, or I guess on the February 24th low, we had now this is my stochastic oscillator here, but RSI would look very much the same as far as this is concerned. We got oversold on the January 24th low. Now we made a new low on February 24th, but we were less oversold. We had a bullish divergence. So I hazard to guess, or I suspect, given the current positioning of the oscillator here, if we do make a new low again below the February 24th low, I suspect another higher low on the stochastic and probably RSI as well. So we'd have like a triple bullish divergence, which again, I would have trouble being too bearish against that, right? Given the context of a triple zigzag corrective pattern. Anyway, back to the weekly here on the NASDAQ composite. Anything remarkable about that? No, just a negative week, but no real candlestick signal there. Okay. NASDAQ 100. What do we have? Yeah, bearish engulfing. So nothing to differentiate there between the NASDAQ composite and NASDAQ 100. Okay, VIX. Another thing. So VIX is pretty weak considering we're potentially about to make another new low on SPX. So I would suspect VIX will make a lower high even if SPX makes a lower low. So that'll be another positive divergence as far as the market's concerned. Now if we go to the VIX VVIX tool, I think we're kind of in no man's land on this. So SPX is below the blue moving average, but VVIX is below the red moving average. So we're kind of just in this sideways chop zone. No real clear trending action here according to this tool. Not on a sell signal, but not on a buy signal either. Just in this neutral slide to the down, or sideways to down slightly. But again, if SPX does sweep down and make new lows below that February 24th low, it's very likely VVIX and VIX will be making lower highs, which will be a bullish divergence against SPX. So something to watch for there. And what else was I going to mention? I guess just as far as my own positioning. So I do still have the longs that I've had since reestablishing on that sweep of the February 24th low. I do have a put spread again in the event that we do come down and make new lows. The put spread will benefit from that. So basically my own positioning mindset here is I want to be long. If we do go lower significantly, I want to get more long. But in the meantime, I want to hedge some downside so that at least it partially offsets the longs going down, or maybe even results in a slight net gain depending how well the hedges work out. But that's my mindset. Not getting mega bearish, not trying to capture some big downside move, but trying to get, well, being long, thinking of getting more long if we do actually go down and make some of these targets, and also putting on little hedges that are cheap to establish. So basically, they don't cost much if they don't work, but they can pay out quite nicely if they do work. I want that asymmetry as far as the hedges. So let's see here. I do have a example to point out that I have on as far as that goes. Let's see. It's an SPX Butterfly Spread. So this one in particular expires on Monday. Let's see. This is the one, I think. Okay, so I am long 1 4160 put expiring Monday. I'm short 2 4100 puts expiring on Monday, and long 1 3950 put expiring Monday. Okay. So if it doesn't work out, it's a relatively cheap hedge. If we expire near 4100, that's the sweet spot on Monday, near the end of the day. That would be the best benefit, and it works all the way down to about 4,040, 4040 or 4045 before we would actually start losing to the downside. And obviously, I would take some action before that was the case. If we start going too far below 4100 on Monday, I would take whatever profit was available at that point. But we'll see. We'll see. This is all in the event that we actually do go down and break some lows on Monday, which is by no means a guarantee here. But just in case we do, I want to have a piece that benefits from that. And again, we'll see. But that's my mindset. And we'll see what happens next week. That's probably all that needs to be said for now on this topic. And maybe tomorrow, if I get a chance, I'll do one of those educational videos that I've been working on entry triggers. So in my case, I like to look for candlestick signals, whether they be bullish or bearish. There's also some scanning techniques on thinkorswim related to that, which I might go through as well in the video. So if I get a chance, at some point I'll do it, maybe tomorrow. Anyway, Serial Trader signing off.